Let's start with a really big what if. What if investors all over the world, all at once, just decided to sell US debt? What happens the next day? It's a massive question for anyone in the markets. So let's dive in and really unpack what a debt crisis like that could mean for your portfolio based on what's happened time and time again throughout history.
Here's what we're going to cover. First, we'll pinpoint the trigger, what we're calling the big red flag. Then, we'll look at the two incredibly tough choices the central bank has to make. After that, we'll explore both paths. And finally, we'll bring it all together with a simple investment playbook to navigate this kind of chaos.
All right, so let's get right into it. Every one of these big debt crises has a starting gun, a clear signal that things are about to get serious. It all boils down to this one single powerful question. You know, when the very people who own a country's debt decide they don't want it anymore, the whole system has to react, and fast. This isn't some slow-moving trend. It's like a fire alarm going off in the entire financial system. And that's what we call the big red flag. It's that moment where confidence just evaporates, and all the debt holders start running for the exits at the same time. This one event puts the central bank, in this case the Fed, in a truly impossible spot, with absolutely no easy way out.
Okay, so the red flag is up. The alarm is blaring. Now we get to the heart of the conflict. The Fed is basically staring at a fork in the road, with two very different paths ahead and two very different destinies.
On one side, you've got path number one, monetization. Just think of it like the Fed firing up the money printers to buy all the debt that nobody else wants. Now, this stops an immediate default, but it comes at a cost. It devalues every single dollar. On the other side, you have path number two, tightening. This is the tough love approach. The Fed just steps back, doesn't print, and lets interest rates go wherever they have to go, which can cause a whole lot of economic pain.
So let's explore that first path, which if you look at history is the one that's chosen way more often. And why is that? Well, because it avoids the immediate catastrophic pain of mass defaults, which makes it a much easier choice for politicians to swallow.
So the Fed basically becomes the buyer of last resort. When no one else is buying, they have to step in. They flood the system with new money to soak up all that unwanted debt, and that keeps the bond market from collapsing. But what does all that new money do to the value of the dollar sitting in your bank account?
Well, in a world where cash and government bonds are actually losing their value, investors tend to run towards things that represent real, tangible wealth. We're talking about the classics, like gold. We're talking about the productive engine of the economy, like stocks. And of course, raw materials and commodities. And yeah, you could even argue that modern digital assets like cryptocurrencies might fit in here too, since, like gold, you can't just print more of them.
Let's zoom in on the most classic of all these safe havens, gold. I mean, for centuries, whenever confidence in paper money starts to fade, this is where investors have turned as a reliable way to store their wealth.
And this is where it gets really interesting. Look at the hard data. Across all these historical cases of currency devaluations, gold produced an average return of 81%. 81. Now compare that to nominal bonds, the very thing being devalued, which lost an average of 5%. I mean, that difference is just staggering.
But gold isn't the only play here. Think about it. When money is being devalued, owning a piece of a company that makes real stuff or provides real services, what we call productive capacity, becomes super attractive. The same goes for the raw materials that fuel our entire economy.
And this chart just says it all, doesn't it? On average, commodities return 55% and equities 34% during these periods. Both just blew bonds out of the water. The takeaway is crystal clear. When paper assets get into trouble, real assets tend to do really, really well.
Okay, so now let's dare to walk down that other path, the road less traveled, for sure, and one that leads to a totally different kind of crisis.
If the Fed chooses not to print money, it's like a series of dominoes falling. Without a buyer propping things up, interest rates have to skyrocket to attract anyone to buy the debt. Those high rates then choke off the economy. Businesses and people just can't afford to borrow. This leads to a nasty deflationary spiral, where prices fall, companies go under, and defaults pop up everywhere.
Now, in this world, the investment playbook gets flipped completely on its head. Instead of running from cash, you want to hoard it. Cash becomes king because its purchasing power is actually going up as everything else gets cheaper. It's a painful, depression-like environment for sure, but holding cash is what preserves your wealth while others get wiped out. So we've just looked at two very different, pretty intense futures. How do we boil all this down into one simple strategic playbook? Let's start with the single most important rule here. No matter which path is chosen, devaluation or default, the one asset that gets hammered in both scenarios is the government debt itself and the currency it's priced in. That is the thing you want to avoid.
And here it is, our final playbook, all on one slide. If the government prints money, which is the most likely path, you want to own real assets that hold their value when money doesn't. That means gold, equities, and commodities. If they take the painful path of tightening, you want cash. But notice what's consistent. In both scenarios, the core principle is the same. Get away from the government bonds and the currency at the very center of the storm.
And this really leaves us with one last big question to think about. When the financial system we all take for granted gets pushed to its absolute limit, it forces us to ask a really fundamental question. What is real wealth? Is it a promise printed on a piece of paper? Or is it something a bit more tangible?